Well, mortgage rates just hit their lowest level we've seen in 3 years, and housing demand is picking up. Pending home sales is at the highest level we've seen since early 2023, and it's during a time of year where we usually don't see it. It looks like in 2026, the housing market is waking up, but it's not going to be waking up evenly. For those of you that don't know me, hey, I'm Chris Lamb, a nationwide mortgage lender. In this video, we're going to talk about what's going on with mortgage rates, with housing demand early 2026, because things are changing. And we're really excited because we're starting to finally see the affordability ease up for many buyers, including investors. So if you're someone that owns a house or you're interested in real estate, this is going to be a really good video for you. Before we talk about what's happening, let's talk a little bit about 2025. 2025 was the year the housing market was stagnant, and affordability was a major problem for many Americans that wanted to buy a property. And many people across the nation were calling for a housing crash, which I completely understand. A lot of people that say that, they simply want to see affordability. But we want to make sure that this video and anything we put out there is simply based on reality. And the facts are this: prices did not crash in 2025, in a year where by any other indicator, home prices usually would have come down in a meaningful way, and that simply hasn't happened. As of right now in January, mortgage rates are at a 3-year low. Freddie Mac just posted an average mortgage rate of 6.15%. It wasn't that long ago that rates were over 7%, and they even touched 8% a few times since 2021. For most people buying a home right now, the difference between where rates were over a year ago and where they are today, you're looking at a $300 to $1,000 difference in a monthly mortgage payment. And this has all happened in the fourth quarter of 2025, when a lot of people are simply not thinking about buying a home, but we are seeing a lot of people paying attention. Like I said early on in the video, pending home sales are at the highest level we've seen them since early 2023. And everyone is predicting right now, including National Association of Realtors, Mortgage Bankers Association, Freddie Mac, and Fannie Mae, that the spring housing market in 2026 is going to tell a different story than the last few years. Now, if we were to play this tape out into the busiest time of year, March, April, May, June, it's no wonder why National Association of Realtors Chief Economist Lawrence Yun is predicting 14% more transactions in 2026. A lot of the economists are also predicting a 4 to 6% appreciation rate year over year from 2026 over 2025. And that's really not hard to believe. Now, for those of you that remember the pandemic, home prices went up 20% or more in many markets just because of interest rates. That was obviously a very big movement in rates. Rates went from 4% down as low as 2%. But what you have to remember is this: historically, when mortgage rates move down, it puts upward pressure on real estate prices, and it always has. I saw a statistic that every time mortgage rates come down 1%, home prices likely will reflect that by a 10% increase. So you're really going to want to pay attention to that. If you're somebody that's been hoping that rates would come down and you're trying to time the market, that could become really complicated if home prices start moving up. Now, I'm just going to be really honest with you. As happy as I am to see mortgage rates come down and to see affordability ease for many Americans, housing is still very unaffordable for many first-time home buyers, and that is a fact. And the truth of the matter is, there is nothing in the future, there is nothing in the data that says we're ever going to see a market where it's going to become affordable like it once was for the first-time home buyer, for the median income in our country. And that's a sad statistic, and I wish it was different. But in order for things to become affordable again, we would have to see a ton of new inventory come into the market, which is just not going to happen. We would have to see home prices come down 20% or more. And I'm just going to tell you, if rates being where they're at, insurance costs being elevated in most states because of the fires and the hurricanes, haven't caused prices to come down yet, it's not going to happen. So what's important for people that want to buy a property to live in 2026 is that you focus on one of three things. The first thing is you have to stop waiting for lower interest rates. When lower rates come, prices move up. You need to build a plan realistically around about a 6% interest rate and use that as your baseline for what it's going to cost you for a mortgage. The second thing you have to do is you have to have a strategy to win with the seller. Now, a lot of sellers right now in January are willing to make a deal. We are seeing a lot of sellers pay for closing costs, which can help you buy the rate down even further, looking at temporary buy downs and ways to get that payment down. And you want to make sure that when you buy a property, you're looking at things like homeowners insurance and property taxes, including the utility costs. When you look at buying that home, make sure you understand the full expense of the property and that you're basing your budget on that, not just the interest rate, because there's a lot of things you're going to pay for when you buy your first home. Now, I think it's really important that you train for the payment. And let me explain to you what I mean by that. For a lot of people buying a home right now that are currently renting, their mortgage payment is going to be $1,000 or more higher than what they're currently paying for a housing expense. And that's a lot. One of the things I recommend is that you take whatever that mortgage payment's going to be, and let's say it's $1,000 more per month, and you start saving $1,000 every month. This is going to help you two ways. Number one, when you buy that house, you're going to have a little bit more cash that you can use for the down payment or the closing costs, or simply just to have some reserves at closing. But number two, you're already going to be in the habit of making that extra payment. So it's not going to be as shocking when you purchase that property and now you have a housing expense that's more than what you were paying for rent. Now, if you're a homeowner right now and you've been one of these people that's been in what we call the lock-in effect, where you've got a 3 or a 4% mortgage, and you've been really thinking about ways that you can tap into your equity, because most people have a record amount of equity right now, I can totally understand why you would want to keep that low rate. But if you're thinking about buying the next house and you've been putting it off for a couple of years, like so many people have been doing, you have to face the reality that you're probably not going to see those rates again, and try to create a plan with a budget to buy that next home. There's also a lot of people right now that have credit card debt, and a lot of those people don't think that they should give up their low rate to consolidate that debt. Here's the thing that you can think about. You can't deposit a 3% interest rate, but if you were to wrap that into a mortgage through a cash out refinance, a lot of the clients that we see right now are saving $1,000 to $2,000 per month by restructuring their debt. And they're not going to live in that house for more than 5 more years. So that 3 and 4% rate does not mean a ton to them if they're not in their forever home. So make sure you look at strategies to consolidate and restructure high interest rate debt. It's a huge opportunity that a lot of people are missing right now. Lastly, let's talk about the investor. Now, I am a real estate investor, and I will tell you that many investors have simply been penciled down. Now, the truth is there are still deals out there. There are a lot of great opportunities when it comes to multi-unit properties in certain states. Short-term rentals are still very, very positive if you buy them in the right location with the right amenities, but it's not as easy as it used to be. One of the biggest things that I recommend people that are looking into becoming an investor do is they look at some of the tax advantages that are available this year by owning rental real estate or investment real estate. One of the biggest ones you're seeing all over Instagram and YouTube right now is bonus depreciation that was reintroduced in January of 2025. This is a huge opportunity that a lot of people don't realize. If you're a high income W-2 wage earner, you're probably told for your CPA there's nothing you can do, and that is no longer true. There are ways right now to buy rental real estate and do a bonus depreciation and take all the depreciation of that property within 1 to 3 years, saving massive dollars on taxes that you would have paid to the federal government. So where you may not make money by buying a property and cash flowing it because of the cost of rates and properties, you may be able to save a ton of money in your income taxes. So make sure you guys are aware of some of those opportunities that exist in 2026. Bottom line, it looks like the housing market is shifting in 2026. And if you're someone who wants to know more about opportunities available to you, make sure you do your research, you get a plan together, because this is not the market where the deals are going to jump off the Zillow page and just make sense on paper. You're really going to have to talk to professionals, and that is something I do. I loan in all 50 states, so if you ever want to reach out to me, I have my contact information in the description below. So these are the things that we see in 2026. As always, I will post more videos on a regular basis. And if there's any comments, questions, I would love to hear them in the comments below. Happy New Year to you, and I hope you have a great day.